Our goal at Nzam is to deliver attractive returns without subjecting our clients to undue risk. We do that by investing in a diversified portfolio of about 20 global fund managers, all of whom share our absolute returns philosophy and all of whom have their own money invested alongside our clients. We seek to participate in the upside and protect the downside. This video highlights where Nzam sits relative to the other main investment options. It illustrates not just Nzam's historical performance, but compares it to a more conservative option, money in the bank, and a riskier one, fully invested global shares with no currency hedging. The data is for every rolling 3-year period since Nzam began in business in September 1991. So the first data point is the 3 years to 31 August 1994, then the 3 years to 30 September 1994, and so on. On the horizontal axis, we show the largest declines suffered over each 3-year period. It's quite possible for the overall return over 3 years to be positive, and for it to include quite a large decline. The size of the decline is important because it's much less stressful to make returns in a consistent manner. On the vertical axis, the annualized return, also for each 3-year period. The size of the circle is another measure of risk volatility. The larger the circle, the more volatile. So a small dot in the top left is the ideal outcome because it reflects high returns achieved very consistently over the preceding 3 years. Conversely, a large circle in the bottom right is the worst outcome, for obvious reasons. As the video rolls, watch the yellow circle, which is global shares, oscillate wildly between the top left and bottom right, and also for it to change significantly in size. Nzam, in green, is much more stable, nearly always generating positive returns and managing to keep declines to about 10% or less and volatility low. Cash, not surprisingly, is very stable but offers more modest returns. Now, if we stop the video in April 2000, we can see that in the preceding 3 years, global equities delivered over 30% per annum, with just a 10% decline. We did pretty well at Nzam too, gaining nearly 20% per annum. Now roll forward to August 2003, and the 3-year return from equities is now a loss of 20% per annum, with a maximum decline of around 60%. Nzam investors had small but still positive returns with nothing like the same downside. It's becoming obvious that global equities can be both very, very good and very, very bad. Entertaining for sure, but not always in a good way. Then again, in September 2007, both Nzam and global equities had earned about 13% per annum with similar declines. Roll forward to February 2010, and the Nzam return was still positive around 5% per annum, which included a 12% decline. Not our finest moment, but in the same period, global shares had both negative returns and a nasty 35% maximum decline. What is consistent throughout the period is that money in the bank is the safest investment, and that global equities have always been riskier than Nzam. If that pattern persists, and we're trying very hard to ensure that it does, those who want entertainment from their investment should buy global equities. Those with no risk appetite at all should leave their money in the bank. But we believe that those who are seeking returns better than bank deposits with modest risk should talk to us at Nzam.